A current account in the Indian context is a part of the Balance of Payments (BoP) that records all transactions related to trade in goods and services, income and transfers between India and the rest of the world. Let's explain it clearly and simply. Why is it called current account? Because it deals with ongoing day-to-day transactions, not long-term investments or loans. These are regular exchanges like exports, imports, salaries, and remittances that happen in the current period. Is it really an account? Yes, it's like a ledger or financial report that accounts for how much money India earns or spends with the world on trade and services, not a bank account, but an economic account. What is accounted for in it? The current account includes goods, also called merchandise. This covers exports, for example, selling cars to South Africa, and imports, like buying crude oil from Saudi Arabia. Services. This includes IT services sold to US companies and foreigners coming to India for tourism or medical treatment. Income. This encompasses salaries, dividends and interest earned from abroad, as well as payments made to foreign investors in India. Transfers, which are one-way flows without returns. Examples are remittances from Indians working abroad, donations, gifts, or foreign aid. What is a current account surplus? It's when India earns more foreign currency through exports and services than it spends on imports and payments. What is a current account deficit, or CAD? Well, it's when India spends more foreign currency than it earns. Essentially, it means that imports plus payments are greater than exports plus receipts. Here are 5 examples of a current account surplus. First, India exports more software services to the United States than it imports from them. Second, foreigners spend large amounts visiting India, leading to a tourism boom. Third, Indian nurses and workers abroad send back huge remittances. Fourth, Indian companies receive high dividend income from foreign investments. And finally, global demand for Indian spices, tea, and pharmaceuticals increases exports rapidly. Now let's look at 5 examples of a current account deficit. First, India imports a large quantity of crude oil, paying in dollars. Second, there is a heavy import of electronics and gold for domestic consumption. Third, payment of interest to foreign investors holding Indian bonds. Fourth, fewer remittances from Gulf countries due to an economic slowdown. And lastly, outbound tourism. More Indians spending abroad than foreigners visiting India. Let's talk about the significance of the current account. Firstly, it's an indicator of economic health. A moderate deficit is normal, but a large one can weaken the rupee and raise inflation. Secondly, it impacts foreign exchange. A surplus strengthens the rupee, while a deficit can reduce foreign exchange reserves. Thirdly, it provides policy guidance, helping the government plan trade and foreign policy, encourage exports, or reduce imports. Lastly, it influences investor confidence. Foreign investors watch this to assess India's financial stability.